you don't mind coming up, really want to get started. But I do want everyone to have their 10 card up. Just try to make sure I know who you are, you know who I am. Knowing me is easy. Thanks. All right, guys, let's get started because we have a lot to cover tonight, as we always do. It's partnership tax. So we're going to have a lot to get through. So let me quickly summarize, because time is never our friend here, what we have to cover. So chapter 1, and whoever just logged on, you've got to put yourself on mute, okay? Whoever just logged on, please put yourself on mute. All right, and you got to turn the camera off. Carol? Carlo. Okay, and I should, and thank you. Now it just reminded me that if we want to get this class paid, I better like it. All right, there we go. We're in business. All right, so chapter 1, guys, is one of those chapters that you're going to learn more after the fact, that you're going to have a better handle after the fact than you are before the fact. So note to self, make sure you revisit chapter 1, but I promise you, as the weeks go on, chapter 1 will become easier and easier to distill and understand. Choice of entity, I stand by what I said the first 2 weeks. You'll hear me repeat it again. 99% of the time, your go-to choice in terms of entities will be a partnership, all right? And I'm not just saying it because it's Wednesday night at 6 o'clock, all right? We talked about formation issues. Insofar as formation issues are concerned, that when you form a partnership, okay? When you form a partnership, now I lost the ability because I'm on eraser. Yep, there we go. That when we form this entity, we have several different code sections in play. You guys know this already. Just like code section 351 makes it non-taxable, code section 721, right? Non-taxable. We all agree? Kevin, you agree?
Yeah.
All right, that's what I want to hear. All right? And when you contribute property down, no surprise, basis plays a critical role. And just like we saw in this sphere of gift, when you make a gift in code section 1015, and there's a carryover basis, similarly, code section 722, code section 723 replicates the carryover basis, right? And we have inside and outside tax basis. The outside tax basis is the basis you have in that piece of paper, right? And Ken, what code section is that? Just look at your little graphic. Brian, what code section? No, 1223 is the holding period. Tom in the back. Just pull out your little graphic. 722. 722, right? Code section 722 deals with thumbs up.
Okay, good job.
Thank you. That's my lucky charm right there. All right. Code section 722, outside basis, inside basis, George. Oh, we just said 722. Ramon?
723.
Come on, guys, you got to hit this. 723, right?
Yeah.
Code section 723. For the basis of the property that's contributed. This kind of stuff, again, for exam purposes and for your clients, you got to be able to hit, really up the ante here, guys. What's the holding period in the property? Holding period, an outside basis. Sandra? Holding period. 1223 what? And is it tacked or not tacked? Always? Yeah, capital in 1231, holding period tacked. If it's not a capital asset or 1231 asset, the holding period is not tacked, including code section 1245 recapture is treated as a separate asset, not tacked, right? All right. So, and the contributed property has a tax holding period. What's my authority? Code section 1223(2), right? So the authors talk about formation issues in chapter 2. They talk about page 40 is a great problem, one that would come up in practice. One similarly, you're apt to see it on the exam, page 40, 41. We're going to see a lot more beginning on page 41. There's a discussion of capital account maintenance, right? How to maintain capital accounts. Why is that so critical? It's critical because the capital account delineates what is the partner's economic stake in this enterprise, right? Does tax basis do that? Absolutely, categorically not, right? It comes down to what is your capital account. And this is the metric by which we're going to decide later today. You're going to be at the edge of your seat. Is that partnership allocation to be respected? Okay, is that partnership allocation to be respected? Okay, so that as we flip pages, you're going to see variations on capital account maintenance. Beginning on page 48, and we're going to, I promise you, we're going to go much more into depth. Page 48 looks at the issue of what happens if you contribute property to a partnership subject to a liability. And here, one of the first things you have to do is decide, is the debt recourse or non-recourse? Because if it's recourse, one set of rules applies. If it's non-recourse, another set of rules apply. So, were I you, and in practice, make sure, maybe for exam purposes, you circle in red, is the question geared towards recourse or non-recourse? Because depending on what happens, you will choose a different path of analysis, right? And generally, Julia, recourse, how do you divvy up recourse debt? Say it loudly. That's and I haven't said it. I canvassed people on WebEx, and they said their one issue is when students talk, they don't speak loudly. I'm not kidding. I'm not making it up. Seriously. So, Julia, for the WebEx crowd, your answer is.
What is it recourse?
How do you divvy up recourse debt for tax basis purposes? What code section comes into play for basis allocations of debt? Just say it loudly. 752, right? You gotta have a real sense of conviction here. You gotta say it loudly like you mean it. 752. So, Julia, recourse debt. How do you divvy up the basis? You're not sure? Michael? Is that with recourse? Alan? Not sure? Minna? I was upper tier, but lower tier manner. No, he deferred to you.
So if it's a recourse, it goes back to the partner.
When you say it goes back to the partner, let me translate, let me help you. It's based on loss, right? Based on loss. Who's going to bear the burden if something hits the fan, right? Right? Who's going to bear that burden? The partner, right? And if it's non-recourse, Chrissy, how is the debt divided?
Company.
Say it loudly. Generally profits. Again, we're oversimplifying it. We're going to get more into depth, but for the moment, that's how it pans out, and you'll see. When you contribute property, recourse, you're going to potentially shed some of that debt, right? And that shedding constitutes a distribution to you. Distributions reduce your outside basis, right? Code section 731. The other partners are treated as contributing property, so their basis goes up, 705. Non-recourse debt, you, again, could be in a position of shedding, but sometimes, Trevor, who's on WebEx, asked this question earlier on email. So Trevor, I hope you're listening. that if the debt is in excess of basis, right, under Tufts, remember that's a minimum gain. So if the debt is, say, 80 and the basis is 50, that 30 is not shed, okay? And you can see some examples in your book regarding that. So, and we're going to get, again, I promise you, we're going to get more into that. If not, I believe next class, or certainly if not next class, the following class. All right? We talked about organization and syndication expenses. They are akin to Code Section 195, 248, and add to your repertoire 709. Been there, done that, right? Up to $5,000 is immediately deductible. The other organizational expenses over 15 years, amortized over 15 years. If you put more than 50,000 organizational expenses, for every dollar over 50, you lose $1 of the immediate 5,000 that you could otherwise expense. Syndication fees just sit on the books. I'm assuming this call, I don't know if this is someone who can't hear me, so I will apologize in advance. I'm wondering if this is a student. Part of me says not to answer. Maybe they got a free cruise here. Hold on. Jay Sullivan. This is Ann with the warranty department, and if I want to extend, all right, so we're not going to answer the phone anymore, so anyone who thought it was WebEx, I'm going to turn off the phone, but I wanted to try to be kind to someone who might. Just because, okay, I'm going to power off. There we go, we're done. All right, Chapter 3. Tax consequences of the partnership, aggregate and entity principles. Any questions, Chapter 2? Again, guys, for partnership tax class, regularly, student surveys, class hours spent outside of class. Just bear in mind, many people spend anywhere from 10 to 15 hours for our 1 3-hour class. That's at least what self-reported. Takes a lot of time, effort, and energy. All right? All right. So, operations of a partnership. The authors talked about the fact that partnerships generally are like a partnership holds an asset for more than 1 year and you buy into that partnership, the partnership's ownership interest will dictate whether or not, for example, it's long-term or short-term. And if it's inventory in the hands of the partnership, it's inventory in the hands of the partnership, even though it may not have been treated as inventory in your hands. So even though it's a pass-through entity, it's treated as a real aggregate, a real entity for purposes of classifying different elections, character of income, holding periods, and the like. Assignment of income. Lucas Fierro, assignment of income. What controls? 721 or the assignment of income doctrine? Which one? 721 rules, right? We're not going to worry about the assignment of income doctrine. We spent some time looking at that. The tax year, Code Section 706, right? We looked at the tax year. There's a series of 4 or 5 rules, right? That control, and then you can make an election under Code Section 444. But there's a toll charge in the form of Code Section 7519. Guys, I'm not going to ask you to compute the toll charge. You know, my exams never go into that kind of minutia. Just be aware of it. Your computer will do those kind of computations. Tax consequences to the partners. The authors talk about those items which must be separately stated under Code Section 702. And then talk about basis adjustments under Code Section 705. That in some cases basis goes up, and in other cases basis goes down. Okay? So basis constantly fluctuates. We spent a little bit of time, I think this is truth. I think on page 83, this summary of Code Section 199A, this is the first time, like you guys, this is a new edition of the book, right? Unfortunately for you, so you had to pay full price. But for whatever it's worth, I thought this was one of the best summaries of 199A I had read, okay? So I compliment the authors I think it's worth reading. Code section 199A, I suspect, has come up in many of your practices, and this is a nice compendium of how these rules apply. So I encourage you to keep it near you and refer to it because it's well done. All right, then beginning on page 94. We said on page 94 that limitation on losses, you guys are used to this, that with respect to losses must be realized, recognized, and allowed. That just goes along with the territory. And that insofar as, and these rules are universal, they're not unique to partnerships, right? We know that losses have to be allowed under code section. What code section, guys? 165, right? Code section 165. Right? Is that caffeinated water, B?
No, just plain
All right,
straight
you
up
need
water.
you need the real stuff. All right?
Yeah.
All right. For
I
partnership
won't be able to sleep, sir.
That's okay, as long as you don't sleep now. All right, so you have loss limitation rules. 165 opens the door to losses, but then there's the code puts in several hurdles, right? And this is not arbitrary, meaning that these hurdles go in order. You got to go through each one first until you get to the next. It's not as if they go, and well, it's not arbitrary. So, Patrick, what's the first hurdle? Basis, right? Code section 704D. Rudy, do you have a second one? Michael? At risk, what code section? What? David? Not sure?
49.
What?
460.
Danielle? Danielle. Danielle. I'm slow learner. Danielle. Not sure? Nikki? 465, right? Code section 465. Okay, Timmy, next hurdle. Next hurdle. Timmy, do you have a new next hurdle? Is that the loudest you can say it? Don't frame it as a question, it's not Jeopardy. 469, right? Code section 469, for what rules, Timmy? For passive losses. And Chisholm, is there any other loss limitation rules?
I don't think we got there.
We didn't get there.
No, we still have to do
Oh,
problem
no, I
two.
know we do. I do. I just
Okay.
wanted to summarize
Oh, okay.
the loss limitation rules in general, and then we're going to get back in absolutely into this. But your pronunciation, I'm going to. Ardita. Ardita. 3 syllables, right? Ardita. Is there another limitation? 461L, right? Which says what? Just say it loudly, because I hear all sorts of noises vis-a-vis WebEx. Limitation on excess business losses, what does it get capped at? Not sure? Jacqueline?
This is the new.
There's new law.
New law.
New law. We're breaking new ground here, Jacqueline. I'm going to mispronounce. Is it Aya? Is it? Aya. I should get 2 A's in a row. It should be Aya. Aya. The limitation? Not sure? Tom? 250 single, 500 married, and if the limitation applies, what happens to your losses? And what does it become? Where does it go? Say it left. Under what code section? Doesn't it become an NOL under 172? And unlike yesteryear, George, you'll appreciate this, under new law. Tom, what happens to NOLs? George, NOLs? Michael, you raise your hand? You get to use up to 80% of your adjusted gross income. So it's not 80% of them. And then you can carry forward indefinitely until when? Until you die.
Oh. So it's 2 years back.
No, it used to be. It used to be 2 years back, 20 years forward. All right, but that's old law. Okay, no more. All right, any questions before we go back over some of the rules in general here? Any general questions? I did email to everyone, or Kathleen did. Mark your calendars. Okay, October 26th. You got to be there. Rumor has it there may be 1 or 2 partnership final exam questions posed. So who am I to say not to come, right? So that's just a rumor. All right, Lee Bryce, there's a song Rumor. So you may want to show up just for that reason alone. All right. I did see, those in income tax, just take 1 minute, see it past weekend if anyone did anything. I did see the movie Rocket Man this weekend, and I always have a hard time watching people self-destruct. That's the movie about Elton John. And if you ever want to be a rock star, watch that movie. You don't want to be a rock star, at least not Elton John. So that's my cultural event. Anyone see it or anything else worth seeing, not seeing? Say again, Minna? You don't have time for that. Only partnership tax. All right, I like where you're coming from. And Mike, no marathons this weekend?
New Jersey and my wife yesterday.
So Mike just did 110 miles, right? No problem. All right, kudos to Mike. He's our Iron Man. But anyone else do anything?
I visited a distillery and a vineyard in Long Island.
Okay, what did they?
Not too far away from the Hamptons. There's this place called Live, Long Island Vodka. They do good vodka and liqueurs made out of vodka. I know you wouldn't be interested in that, but maybe everyone else.
Here's my question, B. So if you go to a distillery and you drink vodka, how does one get home?
Oh, I
No
can handle 3 drinks. And still get home. I can handle 3 drinks and still get home.
I can't. So that's
That's a life efficient.
that's a what?
A life efficient, everyone uses it.
All right. Well. All right. Anything else before we move on, guys? All right. All right. Let's go on. Basis limitations. Let's just keep in mind. Beginning on page 94. We spoke about, and I'm just curious if I can do this without blowing this. So if people have, okay, I'm presuming the people hopefully have been able to resolve their issues, those on WebEx. I can't help you if it's too late, so you should practice, and if you need me to practice outside of the class, let me know. But people have been using this successfully, so if you can't make class a particular night, the time to try WebEx is perhaps not 2 minutes before class, okay? So if you think that you may not be able to make it to class one night, contact me during the day, and we can test it out together, okay? All right, basis limitation, guys. Again, you're outside, not inside basis. Outside basis is critical here because it's going to set the benchmark of what you can deduct. And that's not surprising because you can't deduct more than you invest, right? Can't deduct more than you invest in an enterprise. And we looked at the problem on page 95, went through those. Hopefully you have those rules, have that done. It's pretty straightforward. Beginning on page 95, there's a discussion of the at-risk rules. And the at-risk rules were introduced, I believe, in 1982 or 1984. And the notion was, gee, if you don't have real economic stake, you shouldn't be entitled to a loss, okay? Essentially, you have to have a real economic stake to be entitled to a loss. And this is spelled out in Code Section 465, okay? Code Section 465. And when you look, without going in Code Section 465, not surprisingly, on the top of page 96, the first full paragraph talks about what are the amounts that place you at risk. Your cash contribution, your adjusted basis of property contributed, and amounts borrowed in which you're personally liable. Okay? There's got to be personal liability. So those are going to be considered amounts at risk. If you're not at risk to a particular item and there's a loss, towards the end of that paragraph, it points out, just like under 704D, you carry forward your at-risk losses, okay? You don't lose them, you carry them forward. And finally, the last sentence, that first full paragraph on page 96, if a partner's loss is deferred by Code Section 465, nevertheless, the partner's outside basis is reduced by the amount of the loss. Now, having said that, Congress, we all know the power of the real estate industry, right? The power of the real estate industry enabled it to get a special exception. If you look on the next page, it's delineated in the code, but this was a whopping exception to the at-risk rules. Qualified non-recourse financing exception. That if you borrowed sums of money from a quote-unquote qualified person, which is defined in the code under Code Section 49, okay, that you could be deemed at risk for those borrowed monies, even though, truth be told, you weren't at risk. Hence the prefix non-recourse, N-O-N, non, right? Everyone agree? Non means you're not at risk, so it's sort of an oxymoron to say, gee, you're non-recourse financing, you're treated at risk, right? But that's the power of the real estate industry. All right? So, let's look at, I pointed out, I believe I did, towards the very end of class, page 98, page 99, deficit capital restoration. The fact that you may have a deficit capital restoration will not be considered necessarily as if you are at risk, okay? The fact that you have a deficit restoration in your capital account does not mean that it necessarily, that amount will be treated at risk. And there's case law to that effect, and that's, I believe this is a new addition to this case book versus the last case book. There's 2 new cases that are on this point. All right, let's look at the problem on page 99. We have LP, a limited partnership, or limited partner in a newly formed partnership which is engaged in the following activities. Okay, it has 2 activities. A research and development activity to which LP contributed $10,000 cash. LP's share of partnership non-recourse liability attributable to this activity is $10,000. LP's share of loss from the research and development activity is $12,000. Okay? And the motion picture production activity to which LP contributed $20,000 of cash. LP's share of income from this activity for the current year is $25,000. Okay, so it has positive cash flow. LP's outside basis at the beginning of the year was $40,000, and his share of the net gain for the year was $13,000. What are the tax consequences LP under Code Section 465? Now, keep in mind, why did the authors say, or why did the authors discuss motion picture production in which there's a profit of $25,000? And the point here is that overall this partnership has income, right? Overall it has income, right? From one activity it lost 12,000, from the other activity it made 25. And that being the case, that's where we get his share of the net gain for the year was 13,000. Where's that from? 25 less 13, less 12, right? Everyone see that? And the authors did this because, is this an active trader business or is this passive?
Passive.
This is passive. Everyone agree? Why? Because anyone operating as a limited partner, anyone operating as a limited partner, by definition, is passive. Everyone agree? Anyone operating as a limited partner, by definition, is passive. So the authors presumably put this problem because they want everyone, or want our class, to focus on the at-risk roles. They don't want to have the limitation under Code Section 469 apply. So here, where the passive income exceeds the passive loss, Code Section 469 will not apply. Everyone agree? So just for your notes, Code Section 469 does not apply here because the passive income exceeds the passive losses. Now, Code Section 465C2A, I'll repeat, Code Section 465C2A says we have to look at each of these activities separately. In other words, we have to treat the research and development activity separately from the ocean production activity. Okay, you got to, with respect to passive activities, you got to break it down by activity by activity. How much is our taxpayer at risk here? We'll take a look at Code Section, you don't have it open, Code Section 465. How much is our taxpayer at risk as to the and under Code Section 465, if you have the code open, C2A and 3A deals with the separate activities. How much is at risk here, guys, as to the research and development? Well, how much cash did he put up? 10,000, okay? And how about the non-recourse liability? Is that considered at risk, guys? No, because if you look, you should look at Code Section 465B6. 465B6. Qualified non-recourse financing, under A, it says, notwithstanding any provision of this subsection, in the case of activity holding real property. Is this real property, guys? Real property is real estate, right? Is this real property? No. So is that amount at risk? No. So what's the amount at risk, guys? The amount at risk here, guys, is only 10,000. Everyone agree? How much was the loss?
12.
It was 12,000, right? How much can be used?
10.
10. The other 2,000 has to be carried forward. What's my authority? Code Section 465A2. Now, happens to taxpayers' outside basis here? What is the taxpayer's outside basis? Say again? How'd you get it? What's the starting point? What's his outside basis start at?
10.
No, but we're told outside basis at the beginning of the year was 40,000, right?
Oh,
We're told that. You guys see the flush language? So as a result of these activities, what happens to his basis?
goes up.
It's not a trick question. What about the loss? Should it be reduced his basis by 10 or 12?
10.
But remember, guys, I pointed out to you, look on page 96 and the footnote 104. Everyone see that? If a partner's loss is deferred by 465, the partner's outside basis is nonetheless reduced by the amount of the loss, right? So the basis here starts at 40, it goes down by 12, right? And then it goes up by what?
35.
Goes up by
25.
25,
25. Yeah.
right? Isn't that what they made? So the basis becomes equal to 53, right? I'm just going to point out for your notes that if the partner sold his partnership interest or the partnership itself sold this activity, at that point the loss could be taken. I'll repeat that if the partner sells his interest in the limited partnership, sells his limited partnership interest, or alternatively, the partnership sells this activity, the loss can be taken. What's my authority? Regulation 465-12A and Regulation 465-12B. So in other words, if there's a disposition event, guys, that suspended loss can be taken. The suspended loss can be taken. But again, if you review problem 1, what's the amount at risk again, guys? Only the cash contributed. Non-recourse financing, unless it's real estate, is not considered at risk. Question 2. The A, B, C equal partnership. A is general, B and C are limited. Purchased an apartment building for $540, paying $90,000 in cash. Each had contributed $30,000, right? As a 721. And they borrowed $450,000 non-recourse loan secured by the building. Assume that A, B, C are all unrelated and the partnership holds no other assets. To what extent is each of the partners at risk if the loan is? So in other words, what the authors are trying to ascertain or help you ascertain is, under Code Section 465, let's look at it again, B6, it talks about, under B6, whether or not this is qualified non-recourse financing. Under B6B, it talks about the fact that it, 2i, which is borrowed from a taxpayer from a qualified person or represents a loan from any federal, state, or local government. So that begs the question, what is a qualified person, right? So everyone sees that in their code, 465, B6, capital letter B, 2 little i's, right? And you see the word qualified person. Well, guess what? If you look at 465, B6, capital letter D, it's entitled Qualified Person Defined. Everyone see that? Qualified Person Defined. The term qualified person has the meaning given by such term under code section 49A1D, 4 little i's. Everyone see that? So if you want to turn to 49A1D, 4 little i's, strange place in the code, but it is there. Qualified person is any of the, means any person which is actively or regularly engaged in a business of lending money, which is not, okay, a related person, a person for which the taxpayer acquired the property, a person who receives a fee. Then it says, if you look at 5 little I, for purposes of subparagraph, the subparagraph, the term related person has the meaning given in 465B3C, except as provided in the regulations. It goes on from there. Okay. Can't be a related person. Related person we know from code section 707, code section 267, members of a family, if you own more than 50% of a corporation, all those things. So let's take a look at this. Suppose you get a commercial bank loan which none of the parties own an interest. Okay? In that case, what is the amount at risk? Okay? In that case, Ben, what do you say the amount at risk is?
So this is gonna be qualified non-recourse,
Right?
that, so they would, this would be 0, not gonna have any risk?
Do you say no risk?
No, it's,
540,
it's 90.
540,
Say again, George?
540,
520?
40.
540. Well, let me just ask you to do it. Each partner has how much at risk and why?
I think it's much, okay.
30,000?
30, yeah.
Well, each partner certainly put up 30,000. Everyone agree?
Yes.
And how much was borrowed?
450.
450. Okay. So are they at risk for 30, 0, or some other number?
30.
It's real estate,
I would say 30.
180.
We have 100,000.
EK, you're gonna say?
It's
Yes.
real estate,
Say again, George?
it's real estate.
It's real estate. Is this qualified non-recourse financing? So, in this case, Elizabeth, how much is at risk? 180, right? Because each one is deemed to be liable as to 150, right? Everyone agree? For your notes, 180, because this is qualified non-recourse financing. How about from the seller of the apartment? How much in this case, Alvin, how much would be at risk? How much would you say is at risk? Alvin, give me a number. Brian, see if you agree, and then Tom has his hand up. Throw out a number, Alvin. Brian, you want to throw out a number? Tom, they're all waiting for you.
30,000 each.
Why?
It's not a qualified person, it's a fund financing.
Yeah, B, you're shaking your head. It's from the seller.
It says a person, qualified person includes a person from which the taxpayer acquired the property. So it is a qualified person, right?
No. Tom, where are you getting your authority? Because I know specifically designed to stop people like this from, because they would often inflate the price. So, Tom? Tom, D, in
Yes.
4 little I, the definition of a qualified person, which, by the way, you can see, I circled in red the word not. Okay, the word not is circled right before it says not, and Roman numeral 2, a person from which the taxpayer acquired the property. Did you miss the word not?
I did.
Guys, again, for the record, because no one can see. B.
Yes,
Do I have the
yes.
word red?
Yes.
The word not circled in red? Just for the record, okay? David, just to verify. The word not circled in red?
Yes.
All right. So my point, guys, important words. These books ain't worth much, right? For resale, you might as well mark them up, right? And important words, really, like the word not, or non-recourse, or other things, I really suggest you mark it up, okay? Because it's dangerous if you don't. So the answer here is 30,000, right? Agreed? How about B's brother, who is in the money lending business and makes loans at a rate of interest 25% below comparable rates charged to unrelated borrowers? Okay? What is the amount at risk in this case? Now, let's look together at 465, D6D, 2 little I. Remember that? This is under the definition of qualified person. It says, for purposes of clause I, section 49 shall be applied without regard to subclause 1 thereof relating to finance from related persons. If, laconic if, the financing from the related person is commercially reasonable and on substantially the same terms as loans involve unrelated persons. So you can possibly qualify and being at risk if you get a loan from a related person, as long as it's essentially on the same terms as if it were from a commercial lender, okay? The question is this on the same terms? It looks fishy, right? So, for your notes, who is related here?
B.
B. How much is B at risk then?
No,
Oh,
30.
30. What about A and C? Probably 180 because it's not their brother, right?
So B is at risk only for 30?
Is only at risk for 30, where A and C are at risk for 180.
That just doesn't seem right. If it's B's brother, B should be at a higher risk, right?
No, because B's brother may say, I'm not going to try to collect against you.
Okay.
Right. You must be an only child, right?
No, I'm not.
Forget, so yes.
I wish I was.
Okay, D. The same as C, except the loan is at regular commercial rates. Does that change your outcome, guys? Yes. In that case, how much would be at risk? 180. Everyone agree? All right. For a moment, let me just see if the people. I think Trevor rescued the day, and now Simone can hear us. So thank you, Trevor. Okay, now they want to get. There we go. We're back. Okay. Passive loss rules. Okay. So we've met one hurdle, the basis limitation rules. We got to climb a little bit higher up the mountain, right? The at-risk rules, got to climb a bit higher with the passive activity loss rules. These are spelled out, Code Section 469. Now, Congress thought it was going to make some progress with the at-risk rules, but there was just too many tax shelters still going on. So finally, in 1986, Congress introduces the passive activity loss rules that essentially say under 469A, you cannot take your passive losses against active income. You cannot create tax shelters. So creative tax planners came up with new ways to create shelters, but not the shelters that existed in the 60s, 70s, and 80s. So the first thing, or one of the first things, Code Section 469 tries to help us understand is what is a passive activity. And passive activities, okay, are those activities in which the taxpayer does not materially participate. Material participation is defined in Code Section 469H. 469H. Taxpayer shall be treated as materially participating in any activity, in an activity, only if the taxpayer is involved in the operation of the activity on a basis which is regular, continuous, and substantial. All right? So that's material participation. If you materially participate, if you endure losses, you can take the losses. Notice in H2, it says specifically, except as otherwise provided in the regulation, no, I have the word no circled, by the way, no interest in a limited partnership as a limited partner shall be treated as an interest with respect to which taxpayer materially participates. All right? So just call that to your attention that limited partners, their losses are generally passive. Once again, I want to also call your attention on page 101, footnote 128, that tax basis is reduced. Even if the loss is suspended, just like we saw the at-risk rules, that the tax basis still is reduced. The outside tax basis, everyone agree? Outside tax basis still reduced. Page 102, the authors, straight from the regulations, point out 7 ways under the regulations that you can meet the material participation test. There's not one path to nirvana. There's 7. Okay? Because the definition under 469H, kind of loosey-goosey, the regulations elaborate what is material participation. Rental activities are generally passive. Look at the bottom of page 102, top of page 103. With few exceptions, 469 presumes that all rental activities are passive regardless of the participation of the taxpayer. That's 469C2. There is a limited exception that gets phased out under 469I, limited mom and pop rental activities. Working interest, it's capped at 25,000. Working interest in oil and gas, they get a break. You get a break as long as it's not a limited interest. Portfolio income, page 103, 104. Portfolio income is the kind of income that just generates income. Portfolio income like interest, dividends, and the like. The code specifically says portfolio income shall not be treated as passive income. Otherwise, you would allow essentially passive losses to shelter portfolio income. So Congress specifically took portfolio income outside the realm of being passive. portfolio income by definition is passive. Everyone agree? When you invest in a CD, you're not lifting a finger to earn interest income. Agreed? But if you allowed people who generated passive losses to offset their portfolio income, you would still have vast amounts of tax shelters, right? So Congress, in order to put the brakes on tax shelters, or try to, specifically said, do not treat portfolio income as passive income. Okay? Do not treat portfolio income as passive income. That's 469E. Okay, the authors then talk about general partners, limited partners. Pretty straightforward. Do not worry on the exam. No questions. Not a single one on publicly traded partnerships. Okay? No questions on publicly traded partnerships. And I just call to your attention on page 106. Many of you are familiar with Code Section 1411. What is Code Section 1411? That's the 3.8% tax, right, on passive income. Okay? So the authors point out that all of a sudden Code Section 469 has a lot more relevance because here it's applying in the context of when people earn passive income, that whether or not they're going to be subject to Code Section 1411 and endure a 3.8% tax. So if you look at the last sentence on page 106, it says, hence, the rules for determining when a taxpayer materially participates in an activity have gained a far broader practical application, as they are now relevant to every profitable business activity. Okay? In yesteryear, they were only relevant in the profitable center only if the taxpayer had losses. So now they're relevant just in general. Is it a passive activity? Because if it's a passive activity, Code Section 1411 is apt to apply the net investment income tax, 3.8% tax. All right, so let's get through the problems here on page 106. Producer owns both a 40% interest as a GP, 20% interest as an LP in PG13 Associates, a motion picture production partnership which also pays producer a $100,000 annual salary for her services as a full-time producer. Clocks in 1,500 hours per year. After deducting producer's salary, the partnership has $300,000 net loss in the current year. Okay? Partnership has a net loss of $300,000 in the current year. Producer's aggregate outside basis for a partnership interest at the beginning of the year is $350,000. So it has a loss of $300,000. Outside basis is $350,000. Producer's outside basis is attributable to cash contributed to PG13, a 721 kind of transaction. Okay? So we have a $350,000 outside basis. What code section? 722. I know that's what you were thinking, right? Good. All right. Now, the question is, A, what are the tax consequences to producer from her interest in PG13 for the current year? So she gets her $100,000 salary. And what we'll learn under Code Section 707, that's separate and apart, okay? That's separate and apart. It's not part of her ownership. She's just being paid a salary for her services. So that's going to be separate and apart. It's not clear from this problem, okay? So it's hard. I'm going to say it's more under 707A as opposed to 707C, which deals with guaranteed payment. But for the moment, that's not our issue du jour. So let's stick with the issue du jour, which is how are we gonna treat these losses? Because what is the total loss here, guys?
350 or 300.
300,000. So, doing our mathematics, you guys can handle this. She has a $300,000 loss and 40% GP. So, 300 times 40%, she has $120,000, right? Loss on her 40% GP interest, right? And if we do the arithmetic on her LP interest, she has a 60,000 on 20% of her LP interest, right? Now, what is her tax basis? We know at the end of the year?
170.
What's her basis at the end of the year? Let's just do some housekeeping.
170.
All right, where'd you get that, V?
350 minus 120 minus 60.
Yeah, it's 170, right? And I pointed you to the regulation. It's 469-2D6. I'll repeat, 469-2D6 for the fact that the basis is reduced, even if the loss, we don't know yet if the loss is suspended. But we know, I pointed you to footnote 128, which has that citation. Right? So we know the basis is reduced. Now, that's not the question. The question is can she take the full 180 of losses, right? Does she take the full 180 of losses? Kevin, you say just the 120. Why?
Because that would be her general partner amount.
And what you would say, I think, can I put a word in your mouth,
Yeah,
Kevin?
go ahead.
Please, right? Is that in her capacity as general partner, she materially participates in PG-13. Everyone agree?
Yeah.
So, having said that, she does participate. However, what about and her LP interest? Everyone agree? Under 469H2 is presumed to be passive. Everyone agree? LP interest is presumed to be passive. However, just to make life interesting, there's a regulation 469-5T E3, two little i's. And you guys, if you don't know already, I think you do, you gotta love partnership citations because they seem to go on forever. I will repeat, 469-5T as in temporary T, E3, two little i's. What does this regulation say? If you wanna long story short, if you're doing work as both a limited partnership and a general partnership, it's deemed not to be passive. Okay, I'll repeat. If you do work as both a limited partnership and a general partner, it's considered as if you're doing both. So it takes it out of the realm of being a limited partnership. So that being the case, this taxpayer can take the full 180 of losses, right? Because you have this regulatory site. And when you think about it, it makes sense, right? Is this person immersed in doing business in this activity? So it's not apt to be a tax shelter, agreed? So taxpayer should be able to get the full 180 of losses. Question B. If in A above, the producer spends most of her time farming and only devotes 300 hours to PG-13. So in this case,
And she's still drawing the same salary?
still drawing the same salary. I don't think you want to consider about the salary. What you want to consider about is these losses, because the salary we know is going to be taxable under 61. Okay. Let me just make an observation. No matter what, in question B, for your notes, we're still going to reduce the tax basis, right? B would tell us that. But the adjusted basis, no matter what, is going to be reduced to 170. Agreed? Right, now, that's the issue still is, what is the issue in question B, given the fact she only works 300 hours?
Is she materially participating?
Does she materially participate? George, you're shaking your head no, which is a good visceral reaction, but I just remind you that on page 102 and page 102, you recall there's 7 different ways to get to the path of nirvana, right? You don't necessarily have to work 500 hours. There's ways you can get through with fewer hours. For example, if you're the only one working, say, 300 hours in this activity. And there's a fact and circumstance test, there's possible ways, okay? So for your notes, I'm not trying to be ambiguous, okay? Truly I'm not. But if you look at these different ways, this is under regulation 469-5TA. I'll repeat, 469-5TA. And that's just where the authors picked up those 7 different ways to get to the promised land of material participation. This could go either way, okay? The taxpayer may or may not be successful in arguing material participation. So if the taxpayer is successful, you get the full 180 of losses. Unsuccessful, loss suspended, okay? So again, not trying to be equivocal with your notes. Outcome can go either way. You with me? Okay. Question C. What happens if a producer has devoted 1,500 hours to PG-13 during each of the previous 5 years? So we're going back to question B, but this year only spends 300 hours. So there's been, just this year, there's a decline. You think this would work? Or if you have a 1-year decline? Well, there's a rule, the regulations say as long as you materially participate for 5 out of the 10 years, and so even if you have 1 year where you drop off, it should be okay. So it's 469-5TA5. I'll repeat, 469-5TA5. So what this means is we should have the same outcome as an A. Same outcome as an A. Question D. What results in B above? The partnership loss for the year is only $200,000 because it also realizes $60,000 of dividend income and $40,000 of net gains from the sales of marketable securities. Would this change the outcome? Kevin, you were going to say?
Wouldn't it change the number?
Might change the numbers, but with the loss, what's the outcome with the loss? What are these, what kind of income is this called?
Passive.
Portfolio income. Okay? And that being the case under 469E, it's not considered. Not considered. So therefore, what is the suspended loss? Still be 180, guys. Still be 180, right?
Why did you say suspended?
Because if passive losses by their nature are suspended until they can be used against passive income,
Okay.
or there's a disposition event under Code Section 469G. In other words, when you dispose of your passive activity, that will release the loss. But for now, the point the authors are making is portfolio income has no bearing on the availability of your passive losses. Question 8. What results in B above if producer also has $75,000 of income from an interest in a burned out real estate limited partnership? What is a burned out limited partnership, guys? Can anyone translate that for a client? What is a burned out limited partnership interest? Anyone want to give an example? Most of you know this example. I promise you know this example. The Tufts case. And let me explain. Suppose you buy real estate with non-recourse financing and you borrow $1 million. You don't put a dollar of your own. You buy real estate worth $1 million, and 3 years later, the price, and you just have an interest-only mortgage, right? So the liability stays at $1 million. Sadly, the price of the property declines to $700,000, and you just walk away from the property. It's not recourse, right? Any gain recognition? $300,000. Most people would consider that a burned-out tax shelter, right? Because you're going to be tagged for tax on $300,000, right? And you're not going to have any income theoretically to pay for it, right? But meanwhile, you've got $300,000 of depreciation deductions, but who's counting? Anyway, that's what a burned out real estate limited partnership is. And the translation for this is, what kind of income is that $75,000?
Passive.
Passive, okay? So can that loss be used, we have 180,000 of passive losses, we have 75,000 of passive income. So can they be mixed? Yeah, 469A1. Now you can use the passive income to offset your passive loss, right? So your passive loss would be now 105, right? And in other words, passive income unlocks passive losses. So for your notes, if you just look at 469A, right, you can aggregate all your passive activities. So in this case, now your passive losses would be reduced from 180 to 105. Question F. What result in B above if producer also has $25,000 loss from rental real estate limited partnership interest? Okay. What do we say about real estate activities? They're passive, right? So generally, are the losses suspended? They're generally suspended except?
Passive income.
What's your authority, Minna? Passive losses?
So we can use the income but not the losses?
Say again?
We can use the real estate income.
It
We
be
can
any-
combine-
let me just be careful. You can use any passive income. It doesn't have to be real estate income. And so I just want to, any passive income can be used to, your passive losses can mitigate your passive income under 469.
Okay, but not real estate losses.
Why are you saying real estate? You're
I don't know. Maybe
there's
I need
nothing
to.
to do with real estate. Either an activity is passive or not passive.
Okay.
Okay? Now, in this case, it's rental real estate, just factually, it's rental real estate. And as Viva points out, there's a special exception under Code Section 469I that says if you're below certain income levels, you can take your passive losses from real estate, okay? So that's the good news. So there's a smiley face, right? That your clients can take their losses with respect to rental real estate if their income doesn't exceed certain thresholds. But Viva, that does not apply to a limited partnership interest. Okay? It just says, suppose you're a person who owns rental real estate, some property in the Hamptons that you rent out, and you take, and it's an oxymoron to say a loss, but you're taking a loss for the year for whatever reason. You can take the first $25,000, okay, if your income doesn't exceed certain threshold. But if you own it vis-a-vis a limited partnership interest, you can't take the loss. So if your notes, this loss would be suspended as well. Why? Because it's a limited partnership. It's derived from a limited partnership. And 469I only applies to something not held in a limited partnership. Trent?
Why were they able to use the 75 and question?
To say loudly?
Why were they able to use the 75 and question 8?
Because it's passive income.
Didn't we say that 180 wasn't passive?
Fine, Trent, say it again, say it loudly.
Didn't we say the original $180,000 loss wasn't passive?
We did say it was, we said for these purposes it is passive. Assume it's passive for these
I
purposes.
thought it wasn't passive because
We said we could argue both ways. Okay, Trent, if you recall, it depends. We have to look at those regulations. But assume for this purpose that it is passive. Okay?
Will we have to deal with this kind of uncertainty on the exam?
No, I mean, my questions, as you know, B, I'll say biasly, they're crystal clear and there's no, you know.
Okay.
That was a loud sigh. All right. Question G. What results in B if producer also has $50,000 loss from an investment in his general partnership and owns a working interest in an oil and gas property? Is that loss considered passive or active? Question G.
General partnership.
And we know the power of the oil and gas industry, right? Is it active or passive, King?
Active for,
It's active, right? What's your authority for that? Code section 469C3A. 469C3A. However, in question H, it says the same as G, except now she holds her interest as a limited partner. Does that rule apply anymore? It's passive now, right, George? All right, so if you hold the interest, right, guys, in a limited partnership capacity, then it will be passive. So you change the outcome from G to H, right? Question 2. During the current year, limited partner has investments in 4 limited partnerships as follows. Motion picture production, one little line. Motion picture production in which LP has an outside basis of 10, attributable to LP's cash contribution, right? 721. LP's distributed share of the loss in the current year is 25,000. So in my margins, I put a 25,000 operating loss from this activity. In this partnership. And remember, it's all limited partnership investments, right, guys? Item 2, equipment leasing has a 100,000 outside basis in which 15,000 is attributable to cash, 85,000 to non-recourse liability. LP share of the loss is 20,000. Real estate limited partnership LP has a positive outside basis and 30,000 of income, and research and development limited partnership in which LP has an outside basis of 60, attributable to his 60,000 in cash contribution. LP's share of the partnership loss is 40,000. Consider to what extent LP may deduct his share of the losses from these partnerships in the current year, assuming no carry forwards under the 3 various code sections. So take 1 minute, and try to figure out what losses would be allowed and disallowed. Remember, you got these 3 different hurdles, and they should apply in that order. All right, let's take a look. So, in this particular case, the loss is 25. What's the person's adjusted basis? So how much in the first partnership, how much of the loss is going to be allowed, at least because of the basis rules? 10,000, okay, everyone agree?
Yes.
We're gonna have 3 different activities. And before we get into anything else, we have 10,000, is gonna be allowed. The other, loss, is gonna be carried forward, right? The other 15 is gonna be carried forward, right, under 704D. So temporarily, $10,000 of the loss is allowed, but then we're going to revisit this in a second. Okay? Now, in question 2 little y, we have an outside basis of 100,000, right? So the basis rules are not going to apply here, right? The basis limitation rules. Agreed? And the loss here is 20,000, and the question is, of that $20,000 loss, 704D doesn't set up a limitation, but what about the at-risk rules? Say again? Only 15, right? Everyone agree? Under 465, only 415, excuse me, only 15 is at risk, right? Everyone agree? And 5,000 has to be carried forward, right? Under the at-risk rules. The basis would still go from 100 down to 80, right? Right? The basis is still reduced by the full amount of the loss. We know that. Question 3, or part 3. The real estate partnership has a positive outside basis, and the income from the partnership is 30,000. So we know we have that is passive income, right? Everyone agree? Passive income, right? And that passive income can be used to offset passive income can be used to offset passive losses, right? Activity 4, or partnership 4. We have plenty of outside basis. The loss is 40. How much is at risk here?
60.
60, right? So how much is theoretically allowed?
40. Well,
40, right? Now, let's pause. We've looked at 2 out of the 3 rules for the moment, right, guys? We looked at the 704D, the basis limitation rules. We looked at 465, the at-risk rules. But we have not applied 469 yet. Everyone agree? We've not applied 469 yet. So when we apply code section 469, how much of our losses are we allowed? Because we know these are limited partnership interests. Agreed?
Yeah.
Are any of them active? No. Everyone agree? Under code section 469H2, they're all passive. These losses are all passive. How much are our potential losses? 10 plus 15 plus 40, right? There's 65,000 of potential passive losses here. So we have 30,000 of passive income, right? B, you would tell us then that we could take 35 of the losses, right? We can take 30 of the losses are allowed because this is known as a PIG, passive income generator. PIG, a passive income generator. So that 30 permits us to take 30 out of the 65. The other 35 has to be suspended. Suspended. That 35 has to be suspended under 469. And knowing that the total losses are 65, to figure out the amount of the suspended losses, take 10 over 65 times the amount disallowed, take 15 over 65 times 35, and take, if I figure it out, here's my eraser. So now I take 40 over 65 times 35. These are the amounts disallowed with respect to each activity. 5,385. This is 8077. This is 21,539. That's a 9, 539. Anyway, what I really care about for this last problem 2, is that we would have $35,000 worth of the loss would be suspended under 469. So what the authors are intending to do in this problem, guys, is to illustrate to everyone that when you do this analysis, you got to be sensitive that you don't just deal with one of these loss limitation rules. And again, there's an order to it. First, you apply the basis rules, you apply the at-risk rules, and you apply the passive activity loss limitation rules, right? And then, just to make your life interesting, what do we have to add to the mix in the year 2018 and going forward at least? Excess business losses under code section 461L, right? So now we have yet another, if you added a few more zeros to this, right? And you're a single taxpayer, instead of 35,000, it was 350,000. The loss might even be, the loss allowed might even be, disallowed I should say, might even be larger, all right? So just pointing this out, this is on page 108. Page 108 in our textbook, again, if you have the new textbook, which I hope everyone does have, expresses this loss limitation rule under code section 461L. And most of you are familiar that many of these rules sunset in 2026, and this is one of them. I suspect there are some rules that are going to be with us, I think, for a long time and aren't going to sunset, and others will. I don't think this is going to sunset. That's my gut. That Congress, this is a revenue generator, right? By putting a limitation on the amount of business losses allowable. And there's not a big lobby group that will cry that we need this back. So I'm just sharing with you that I wouldn't be shocked if this one survives beyond 2026. Now, guys, this is a natural break point. Hear me out for a minute here. We are getting to, I'm going to mispronounce it, the piece de la resistance, the essence of partnership tax, right? Because partnership allocations are one of the fundamental defining attributes of partnerships that's singly differentiated from any other business entity. All right, so you really have to have your druthers and your wits about you, because this is the kind of stuff that you really need to absorb, because people who come, not only will they ask you what kind of entity they should form, they will ask you if they do form an LLC periodically. They're not going to ask you every day, every week, every month, but periodically you will get questions about partnership allocations. So be forewarned that this chapter is going to be of critical, all these chapters, but this one in particular, and then this chapter extends several other chapters, because first we learn the general rules here, but then we're going to learn about limitations on some of the allocations. So why don't we take our 10-minute break and get your caffeine. I will see you back in 10 minutes, okay?